Hello and welcome to this Thursday edition of FreightWaves Now. I'm your host Anthony Smith, and coming up, I'm going to jump in for a long overdue econ shipper update. But first, we're going to go to Zach Strickland with a carrier update brought to you by PowerFleet. Stay tuned.
Hello and welcome to your Thursday carrier update presented by PowerFleet. I'm Zach Strickland. So we finally have reached a point where volumes are starting to really rise up again right before the holiday, as anticipated. Now, we didn't anticipate it to be quite this robust, but here we are. So I've got our outbound tender volume index showing we have breached the 12,000 point for the first time since all the way back in March. When we were seeing significant increase in volumes on that panic buying spree. It continues to rise, and it's rising at an accelerating pace as we approach July 4th holiday. This is not unusual, as we do normally see a ramp up right before the holiday as shippers try to push a bunch of freight out before they don't have availability. So what is interesting about this, though, is that we are starting to see tender lead times decline as we approach the holiday. So this, again, not necessarily unprecedented, but the fact that we're seeing a sharp decline in tender lead times is going to have a compression factor, in the market itself. So you had 3 days a week ago to get some of that freight. Now all of a sudden you have 2 days to get that freight. You're going to double up on your pickup requests on the same day, which is going to tighten capacity exponentially over the next couple of days. So as volumes are increasing now, well above what we would normally see this time, for the rejection rate that we're seeing right now, and tender lead times are compressing at the same time, you're going to start to see a rapid acceleration in that rejection rate, as you see right here in this chart right here. So we've got our outbound tender rejection index in blue. And this is our current year. Right here is this one. You see this big old U shape right here. And you can see over the last week or so, we have really accelerated tender rejection rates, now up above 11% for the first time again since our March-April fiasco there. Seasonally speaking, we do see an increase in tender rejection rate right around July the 4th. This is last year in orange. Not a big peak season in the summer. 2018, again, considered one of the more robust or tighter markets that we've seen in recent history. And now we are accelerating rapidly towards a 15-20% potential peak if this maintains its current course over the next week or so, which, seasonally speaking, it typically does all the way up until the 4th of July. So carriers out there that are operating in the spot market here over the next week really need to be paying attention to this tender rejection rate and how high it goes and how fast it goes. The rate of increase is just as important as the absolute value of the number. So tender rejection rates really taking off right now. Again, keep in mind that we are still below where we were in Christmas of 2019. So it's not like we've seen this is an unprecedented level of tender rejection. It is, however, a very important rate of increase for the tender rejection rate right now. So conditions changing rapidly. Again, we don't expect this to really slow down until July the 4th next week, or July 3rd, as we approach the end of the week where we celebrate the national holiday. So I've got our weighted rejection index pulled up on this side. This is our tender, rejection volatility map on this side. And the reason I pull this up is that the weighted rejection index really tells you where in the market the most significant rate of increase of tender rejections combined with volume are. So those markets that have that high amount of volume is going to value that tender rejection rate increase a lot more in those markets. And today we can see a value of 20.8 in the Atlanta market. Atlanta, of course, the second largest market in the United States in terms of outbound tender volumes right now. And so any kind of rate of increase in the tender rejection rate is really going to produce a high value here. And we're seeing a 20.8. That is a significant level of weighted rejection index value. We've got Dallas, Texas, still operating at a high level. We talked about this over the last few weeks. Ontario, California, again, significant level of tender rejection increase. So some of the biggest markets in the country right now are seeing these increases in tender rejection rates. Let's break down Atlanta real quick. Why is Atlanta popping off right now? Outbound tender rejection rate up for van or total rejections over 11%. Reefer still only about 8% in that market right now, so it's not a reefer situation, although we are seeing increasing reefer rejection rates. Tweener rejection rates driving a lot of it. So that super regional freight coming out of Atlanta right now, really hot commodity. And that'll do it for today's carrier update.
The comprehensive logistics offerings from PowerFleet cover in-cab ELD, fleet management, trailer tracking, cargo monitoring, and tracking other assets such as chassis and intermodal containers. Power up your operations with PowerFleet.
Hello and welcome to your Shipper Econ Update. I'm Anthony Smith, not only the host, but also doubling as the lead economist here at FreightWaves. And today, we're going to jump into some latest trends. So behind me, we're going to talk about durable goods orders. And the first thing before we jump into durable goods orders, this numbers just came out, so we're still diving into some of the analysis here. But initial reports show that durable goods orders rose 15% from last month. A lot of people are going to tout this as a rebound or a recovery or so. The important thing is to dive into these trends, and that's what we're going to touch into here shortly. One of the things to note on this 15+% month-to-month gain is that this is also 13+% down from the year-ago level. So always keep things into perspective. So when we're looking at durable goods orders, one of the areas I like to look at first is non-defense capital goods new orders. The significance with non-defense capital goods new orders is that it is essentially measuring business-to-business activity. And what we see here in non-defense capital goods new orders is that there was indeed a tick up to just around 2.5%. Now, the key thing here is that this is still around 2+% down from the year-ago level. What this tells me is just how weak business investment was this time a year ago if we're just now barely getting close to year-ago levels. And so this is a trend to keep eye on and really kind of keep a close eye on when we're diving into the latest numbers from manufacturers. Now, another trend in this report was the automotive sector. Manufacturing for automotives was really a significant part of the latest report that really kind of drove up results. When we're looking at automotive sectors, it's going to show that that was up over 20% on a year-ago month-to-month basis, and this was down over 20% on a year-over-year basis. So this again tells us that there is a ramping up, but still a far way to go. Next up, we're going to jump into the consumer side of things with jobless claims. And so with jobless claims, one of the things that we have to watch closely is initial jobless claims. These numbers come out on a weekly basis, released every Thursday at 8:30 p.m. on the Eastern Standard Time. And what we see is that there has been indeed a staircase effect here in weekly jobless claims. But one of the other things to note is that this has indeed started to slow down. And so this has been a bit of a sticking point as the economy starts to reopen up throughout the country. But the main thing is that this is really starting to ease. And so the initial jobless claims aren't coming down just as quick as people had hoped for. Now, one of the other aspects that I think you should also kind of keep in mind of when looking at initial jobless claims is going to be continued claims. Now, these are individuals that have applied for jobless claims and continue to apply for jobless claims. This is also known as insured claims. And so when individuals apply for jobless claims more than once and they remain unemployed, this is the measure that they fall under. And so we're looking at continued claims. The main part here is that this is starting to come down. And so when we're seeing this decline in initial and continued claims, that's a good sign that there is some momentum being built for some of the recovery. But again, this has not been exactly a continuous drop down. When you're looking at jobless claims and initial jobless claims and continued claims, there are a few differences. So for the initial claims, it's going to measure the most recent week of unemployment claims that came in. When we're looking at continued jobless claims, that's going to measure 2 weeks ago's data. So this is a little bit lagged, not as popular, but indeed something to keep an eye on to really kind of gauge the pace of people kind of returning back to their workforce. Over the last 14 weeks or so, the initial jobs claims have piled up to over 47 million as of now. That's the latest estimate. So it's really showing the overall impact that this has had on millions and millions of Americans throughout the country. We're going to jump into these numbers a little bit more detail on our midday market update, so be sure to tune in. And as always, I'm sure the dude, Michael Vincent, is going to jump into some of these trends in his freight forecasting show, so also be sure to tune into that as well. And that's also going to wrap it up for this edition of FreightWaves Now. So thank you so much for tuning in. As always, we're always streaming around the clock, so check out our FreightWaves TV app and all your favorite streaming platforms. Thank you so much for tuning in, and we'll see you on the next episode.